So as the planet is heating up, and it seems like there's data centers sprouting up left and right, there's one industry that is quietly becoming the backbone of our future: the HVAC space. Yes, friends and family, heating, ventilation, and air conditioning. In this video, I'm going to be going over why I think this is the case, and then my 7 picks in the HVAC space, and then also towards the end of the video, I'll be going over my fair price, what I'm willing to pay to buy into each one of the 7 companies that we cover. And by the way, my wife used to work at an HVAC company before hopping over to this company that allowed us to go to Japan. And as I was doing my due diligence and research for this video, I actually had to ask her a ton of questions, because if you can't tell, dude, I have soft hands. But she, on the other hand, she understands almost everything there is to do with the HVAC space. So between you and me, I feel like my wife would have been the better presenter of this information, but she's camera shy. Anyways, let's talk about the bull case surrounding the HVAC industry. So number 1, the AI infrastructure and AI data centers, dude, everybody knows it generates a crap ton of heat. So HVAC systems, especially those that are manufacturing those high-end cooling systems like chillers and liquid cooling, it's super critical and crucial for their operations. So as more and more tech companies spend a crap ton of CapEx, capital expenditures, to build out data centers to support their infrastructure and cloud network and anything to do with AI, language learning models and whatnot, I think that's a good indication of the role that HVAC is going to play. Because if they're building out more data centers, then if you put 2 and 2 together, more HVAC systems need to be put in place as well, right? So right now, pulling up Google, one of the big tech players that's spending billions of dollars on CapEx to build out their data centers. We're gonna go over to their financial statement, the cash flow statement. And if we scroll down to find capital expenditures, trailing 12 months, they're spending $66.9 billion on CapEx for primarily data centers. And another one is going to be Microsoft. We're also going to scroll down this cash flow statement, and if we go to the capital expenditures, they're spending $64.5 billion. Primarily, I would argue 95% of this budget right here is to build out the Azure network and anything to do with AI. And we'll do one more, Amazon Web Services. If we scroll down and take a look at their capital expenditures, $107.6 billion. Now, a caveat, Amazon probably spends $20 to $30 billion to build out their fulfillment centers, logistics, and anything to do with their transportation hubs. But I would argue a good $75, maybe $80 billion of this $107.6 billion towards data centers. And I'm showing you all of these numbers to prove the point that data centers and the amount of money that companies are spending towards them, it's only exponentially getting bigger. And I lied, because I want to do one more, Meta. Let's see, if we scroll down and take a look at their capital expenditures, $52 billion. When you take a look at the pattern of their capital expenditures, 2015 used to be $2.5 billion. Look at the trend and how aggressively it is going up. So in 2022, it was $31 billion. Facebook, friends and family, Meta, Instagram, and the parent company of WhatsApp now spending $52.1 billion CapEx. And then reason number 2 as to why I'm bullish about the HVAC industry is that across the board in the EU, in North America, and in some parts of Asia, there is this movement of electrification and ESG green building codes. Meaning, depending on your jurisdiction or location, the governments are pushing for energy efficiency across the board to replace everything that's old from like the 1950s, 1960s, the infrastructure that doesn't make sense. So HVAC upgrades are going to be a key component of that effort. And then number 3, as a guy that spent time in the supply chain industry, the maintenance revenue is going to be a key component of the HVAC's success in the future, because it's not about just buying an air conditioner or a chiller one time. Absolutely not. There's going to be a reoccurring revenue model and a stable cash flow because of the services that are going to be rendered and the maintenance and the repairs and the upgrades. So for me, I think about it like this. If companies like Apple are charging services for your iPhone or MacBook month over month and year over year, likewise with industrial equipment like chillers and air pumps and heat pumps, there's also going going to be aftermarket services, but that's not to say it's all rainbows and sunshine and beautiful skies when it comes to the HVAC space. Because with my wife, we thought about two reasons as to why you might want to hesitate with the HVAC businesses and companies. Number one, they do tend to be cyclical, especially if they operate heavily and their customer base is residential. Because if the housing market slows down, or real estate development slows down, or construction projects are halted or are frozen, that's also going to decrease the HVAC demand. And then number two, their margins are kind of tight. There's not much profit margin because it's capital intensive and they're physically producing a product that requires a crap ton of labor and raw material costs like copper, steel, refrigerants. All of that stuff can be kind of pricey, and depending on the market cycle, could be expensive to procure. So your procurement team has to be on point and performing above average all the time so that your margins can be good. But I don't think those two reasons are more powerful than the three bullish reasons. So with that out of the way, now let's talk about the 7 companies in the HVAC space that I think are the biggest opportunities and are the ones on my radar and watch list for now. And something that you have to understand is that they are not in priority ranking order. Just because number one is number one doesn't mean they're the pound for pound best. And by the way, on July 28th and 29th, there was a glitch with YouTube's ad system. Something went wrong on YouTube's end. So some of my best performing videos that I ever uploaded onto this channel didn't make anything. It made like 20 cents in revenue. So I was pretty grouchy, irritated, and angry. And it took me like a full 2 hours just to calm down and be like, okay, it's okay. You can go back to the drawing board and you can start pumping out content now, because now it's fixed. But all of the views that I gained in the past like 2 to 3 days didn't count. It kind of hurts, but I'm finding comfort in the fact that we do have members of the community that are a part of the Patreon supporting the channels. When I think about it like that, I feel blessed and grateful. So even though YouTube is only paying me like 20 or 25 cents for some of my best performing work ever, you guys still have my back. And by the way, I thought about it today in my journal while I was reflecting on how life is going. I mean, yes, this was a setback. This was a really good test of me to regulate and control my emotions from getting super pissed off. But this is the first video I'm uploading in the month of August. I feel like time is going so freaking fast. Like after the age of 22, dude, life is just happening in the blink of an eye. And the reason why I'm calling this out is in 2 freaking months, I am about to become a first-time father to a daughter. So I'm like, dude, I feel so nervous, so scared, but at the same time, I'm excited. I cannot wait to teach her the ways of life, how to be a good citizen, how to do dividend investing, teaching her everything that wasn't taught to me when I was younger. So pretty stoked on that end. But anyways, I'm rambling. Let's get into it. So company number 1 is going to be Trane. Ticker symbol TT, and they manufacture HVAC systems like heat pumps, chillers, and air conditioners. Specifically, they're making this pivot to make their equipment for the data center boom. And the demand for their business is so freaking high that right now they have a $7.1 billion backlog of orders and contracts that they need to fulfill. They can't make their stuff fast enough. Doesn't that kind of remind you of NVIDIA and their chips for the data center players? Once again, there's so many different companies that are supporting the data center movement and infrastructure. It's kind of mind-boggling. And I feel like HVAC is a category that nobody talks about. But anyways, their future, from what I can take away and gather based on their earnings call and reading through their investor presentation, it looks pretty darn bright. And despite the tariff situation, they also increased their 2025 guidance. So they're expecting even more money for the latter 6 months of this year. But something that you do want to keep in mind is that their footprint in Asia is not doing too hot. However, their North American line of business is making up for it because the data centers are being propped up on all corners of the US. And if we pull up Trane to take a look at their financials and their fundamentals, so right now their market cap is $97 billion. The revenue that they're generating is $20.7 billion. I would argue their price to sales ratio is nothing too crazy. Let's look at their financials. So take a look at their revenue. Look at it visually. So up until about 2020, relatively flat, or actually on the decline, because in 2015, it was $13.3 billion. And in 2020, we're talking about $12.4 billion. So up until the data center boom, it was a declining and a dying business model, if we're going to be quite frank, objectively dying. However, since 2021, just look at the amplification of their revenue, their top line, $20.7 billion in the trailing 12 months. And in 2020, it was $12.4 billion. By next year, the forecast and prediction is that their revenue is going to double from the numbers that they posted in 2020, which I think is absolutely diabolical. Because in 2018, it was also $12.3 billion. Fiscal year 2020 was $12.4 billion. To go from that to $20.7 billion, super impressive. And if we scroll down to take a look at their bottom line, their net income, their profits, just look at this. This is absolutely diabolical. So the profits of money that are going into their pockets after funding for everything on the books and after paying for the business expenses, $2.8 million. But what I care more about is their EPS, their earnings per share, so their profits per share. And if we take a look at the growth of it, it is absolutely diabolical once again. In 2020, it was $3.50. Now we're talking about $12.60. Pretty darn impressive. And if we hop on over to their dividend profile, nothing to write home about. When it comes to their dividend yield, it's less than 1%. But what I do care about is that this number right here, $3.76, it's growing at a rate of 11.9% year over year. So I like what I see when it comes to Trane. And when we take into consideration their adjusted stock price total return, meaning their share price appreciation plus the dividends paid out, let's take a look at their performance in the stock market. So year to date, their total return is 19.2%. By the way, financecharts.com had a rehaul and it looks so much better. The interface and the website, love it. Feedback right there. And if we zoom back 1 year, 32%. And if we zoom back 5 years, because that would document when their performance started to grow in scale, 5 years, 319%. So you're telling me that an HVAC company would have 3x your money in 5 years. Gets better. Let's zoom back, I don't know, let's say 20 years, because we have 6 other companies to talk about. 2,700% in the past 20 years. Now, friends and family, I get it. This is the past. Past performance is not indicative of future gains, but with their future catalyst of the data center boom and movement, who's to say this is going to stop? Right? Now, do I have your attention? Can we move on to company number 2? And that's going to be Vertiv, ticker symbol VRT. And they do data center cooling, which is known as thermal management. And they also do power management products for electronic equipment and life cycle services, meaning maintenance, repairs, service upgrades, and whatnot. So they do it all. So an end-to-end business model, and they're crushing their numbers and expectations. As a matter of fact, Vertiv just raised their guidance and forecast for the rest of this year and for the foreseeable future. So when we take a look at their numbers, they are absolutely trading with a premium baked in. Because in comparison to Trane, Vertiv's PE ratio, their trading multiple, is a 69. So their stock price to their earnings per share, that ratio is a 70. That is pretty darn steep for an HVAC company. And if we take a look at their numbers, I mean, it's the same story as Trane, right? Take a look at it visually. Up until 2020, it was a dying, stagnant business model. The top line essentially went from $3.9 billion in 2016 to $4.3 billion in 2020. That's hardly any growth. But in the past 5 years, just look at this. It's absolutely wild. In the trailing 12 months, Vertiv posted $9 billion, which means effectively they doubled their revenue from 2020, which was $4.3 billion. Absolutely impressive on what they are accomplishing and the numbers that they are posting. And if we take a look at their profits, you can see that up until about 2020, They were unprofitable. They were in the red. They were negative. They were losing money to operate the business. But since 2022, because it looks like it did decrease by negative 35% year over year, since 2022, their net income has been increasing at a very diabolical rate. 500% year over year, 7% year over year. And for the trailing 12 months, we're talking about a 62.8% increase to their bottom line. By the way, my neighbor across the street, they ordered Domino's pizza delivery. So seeing that as a shareholder of Domino's makes me happy. But anyways, as we jump on over to their balance sheet, there's a few things that I'm looking at. I just want to take a look at the cash and cash equivalent situation. They have $1.7 billion. If we scroll on down and take a look at their total debt, $3.1 billion. And it looks like it's pretty manageable across the years. It's roughly around that $3 billion mark. Despite their revenue getting exponentially bigger, they try not to take on more debt than they can handle. And I'm saying that because since 2018, it's hovered around $3 billion, except during the pandemic, which I think they probably paid down their debts because back then there was a lot of fear and uncertainty. However, once you take all the cash and cash equivalents on hand and you pay down their total debt, all of the loans on the books, they would still be on the hook for $1.4 billion of loans. So something to keep in mind, but I don't think it's too bad for their growth story. If we jump on over to their dividend situation, a 0.1% dividend yield. My goodness, I felt like Google and I felt like Apple were being stingy with their dividends, but Vertiv is a 0.1%, and that takes the cake. However, something that you want to keep in mind is this number right here. This 15-cent payout is growing at a rate of 83% year over year. So you might dismiss this, but friends and family, your dividend payout would still be growing by 83%. That's absolutely wild. If we take a look at it visually, it looks like they paid 1 penny in dividends once a year. And then they moved on to a quarterly dividend payment model. I would say they're on the right track. I like what I see. And if we hop on over to take a look at their performance in the stock market, oops, not vertical, Vertiv. By the way, I got measured for my vertical jump back when I was a college freshman, and it was a 39.5-inch vertical. And on a good day, it was a 40-inch. Dude, back then I was so freaking athletic. Sometimes I look at myself in the mirror, I'm like, dude, what happened? What happened? You make YouTube videos and you hardly get 500 views. How did life go so wrong? But anyways, if we take a look at their stock market performance, for the past 1 year, we're talking about an 85% total return. Dude, that's really crazy. And that's including the major dip in April. But if you bought into them back in April, I feel like that number should have been around, how much were they? They were like $59 for their adjusted stock price. Now they're currently like $145. Dude, that 85% number would have been so much higher, literally in 3 months, which I think is pretty darn good performance. And if we take a look at their performance in the entirety of their stock market history, it looks like they debuted back in 2018. Then your money would have grown. What is that? 2018 till now is like roughly 7.5 years. 1,300%. Dude, pretty good. Didn't I tell you the HVAC industry silently performing so well and nobody gives them any attention? Luckily, my wife used to work in the HVAC space, so I always kept it in mind. And then one of you, shout out to Ryan, you kept reminding me, by the way, shout out to every single one of you that give me feedback, engage, and put comments on the videos. If you feel like I'm ever ignoring you, just give me another gentle reminder. You can copy and paste your exact same comment. It's just sometimes I have like stuff floating in my head, 100 miles per hour. I have ADD and ADHD. It's not that I'm intentionally ignoring you. It's just I get sidetracked and then interested by the next thing, and then bam, I forgot what I said I was going to do. But all that to say, shout out to Ryan for reminding me about this video again and again. Sometimes that's what you have to do, and I'm so sorry. It's a terrible habit of mine. But anyways, 1,300% total return. I think there's a lot to like with Vertiv. And the next company that we are taking a look at is AAON. And they are an HVAC equipment manufacturer that makes their products in the US. Every single one of their facilities and factories are based in the US. So that means the cost to do business is going to be very high because of American wages. However, on the other hand, they're also not going to be as impacted by geopolitics, such as some of the other companies that do all of their manufacturing in China and then ship it over here. And something else that you want to keep in mind with AAON is that they do not do residential HVAC. They only do business with commercial and industrial customers. So where do their HVAC equipment end up? In office buildings, data centers, fulfillment centers, and that list goes on and on. And instead of making specific cookie cutter models for everything and everybody, a good chunk of their HVAC equipment is custom made for custom needs. So to paint it in another picture, when you think about the semiconductor AI chip race, NVIDIA makes theirs to a specific specification. Same with AMD. Whereas on the other hand, Broadcom, ticker symbol AVGO, Broadcom makes custom chips tailored towards their customers' needs. And I think Marvel Technology is also doing the same thing. And from their 2021 acquisition of BassX, they now do operations in data center cooling solutions. Prior to that, it used to just be the traditional HVAC stuff, but now they also do data center stuff. So I would argue their story has pivoted into being that of a growth one. However, at their Investor Day back in June, they said that they're expecting their revenue to only, and I say quote unquote only, grow at a rate of 12.5% year over year for the next 3 years. Investors in Wall Street and hedge fund investors, they did not want to hear that. Only 12%? Not good enough for them. Let's take a quick evaluation of their numbers. I guess we can do things in reverse. Dividend yield is 0.5%, nothing to write home about, absolutely sustainable. Meaning, do you know what the payout ratio is? That says that out of their EPS, their earnings per share, their bottom line, their net income per share, 18% of it will be utilized to fund the dividends per share, which is going to be 40 cents. Hopefully that makes sense. And when we take a look at their dividend growth, I think their leadership team is being strategic because not only are they projecting their revenue to grow at a rate of 12.5%, but they're also able to grow their dividend at a rate of 12.5%, which I think is phenomenal. I love to see that. Now let's look at their financials and numbers. By the way, what's their overview? $6.7 billion market cap. So it's not the biggest company in the world, but far from being a micro cap. Revenue is $1.2 billion. First one is going to be the income statement. And unlike some of the other companies that we evaluated so far, it looks like in their company history, they have always been posting positive and growing numbers. And it just dawned on me that in 2020, they grew by 9.6%, unlike other companies, because they're based in and they manufacture in the US. So I think AAON is a really good example of what happens when you source and you build your stuff in the US. But I think they still buy some materials and ingredients and equipment from China, and then they do the final build out here in the US. But needless to say, with other companies that do most of their building overseas, dude, they got shafted in 2020. So to see AAON, I think this is a really good proof in the pudding that if you do your business in the US, it might cost more to run like their gross profit is not the juiciest thing, right? Like in the trailing 12 months, we're talking about a $1.2 billion revenue, their top line, and their cost to do business was $869 million. So their gross profit, we're talking about $391 million. I would argue if they did most of their manufacturing in China, I think their gross profit would have been a lot higher. However, what I care about, some people might disagree, but I like to look at the percentage change year over year. And to see it be in the green like this, never having any steep drop-offs, dude, that's a huge green flag. However, all this goes out the window if they're not profitable, right? Let's take a look at their net income. And that's where the situation gets a little chaotic. Because when we take a look at their net income, dude, sometimes it goes up, sometimes it goes down. Seems to be pretty inconsistent. And it looks like they reached their all-time high in 2023, and they posted $177 million for their profits, which is pretty good. But since then, it's only been declining. So I think the cost to do business right now, it's hurting them. And I think tariffs and everything else is probably not helping them. Take a look at their earnings per share. Right, since 2023, it's declining. But prior to that, it's also very inconsistent. It goes up, it goes down. But on the other hand, if we take a look at their performance in the stock market, wow. The past 1 year, you would have been down by -5%. And I think if we jump on back over here, take a look at what's happening. It looks like about a year ago, they were $86 a share. And that's like in November 2024, they were roughly $137 a share. But since then, dude, they've just been having a rough sell-off. It looks like they hit their low of about $69 back in June, and it's slowly recovering. So that is something to keep in mind. So unlike the other companies, their performance, not as pretty. But also, in a contrarian perspective, that could be a buying opportunity. You can see that this company has a lot of potential, and right now they're going through a tough situation, so to buy them while they're at their lowest, maybe not the worst idea, I don't know. Take a look at this. So past 5 years, 116, oh, looks like they debuted on the stock market, publicly traded 2020, so roughly 5 years of history, and 116%. So perhaps not the juiciest one that we have seen here so far, but I would argue not bad. And the next HVAC company is Carrier Global, ticker symbol CAR. And it's an old school HVAC company that also happens to do transportation refrigeration as well. So, you know, like those big trucks that are carrying those tubs of ice cream. Yeah, it needs to be refrigerated and kept cold. That's Carrier Global. And they have a crap ton of brands under their umbrella, such as Viessmann, Toshiba, Automated Logic, Bryant, Day and Night, Noresco, and the list goes on. And my wife was telling me how important and popular those brands are, because between you and me, I've never heard of any of those brands, but she was going on and on about why this is good and why that is bad. And I really wish I could have recorded our conversation, because I think there's a lot of insight when you hear it from an insider, from someone that used to be in the space and industry. But anyways, if you can't tell by the name of their company, Carrier Global, they have a huge international footprint. They operate all around the world, in Europe, Asia, Africa, North America, and etc. However, for the past 2 years, I would argue that they're making a hard pivot into data center cooling, because year over year, well, based on their current earnings, their US residential HVAC sales declined by 60%. So I think they're seeing that that business model is slowing down. Less and less people are upgrading or are buying their HVAC stuff to build out homes. But in the commercial side of the business, it's looking pretty darn good. So despite that 60% drop off, their 2025 guidance is going to be $23 billion in revenue, and their adjusted EPS is going to be $3.05. So based on that, if we jump on over to their numbers, fiscal year 2024, they posted $24.4 billion. And they're saying by the end of 2025, $23 billion. So it is still growing, but it seems like that growth story is slowing down. And if we take a look at their adjusted EPS, which is the what? The profits per share, the net income per share, the bottom line per share. It's going to be $3.05, which is going to be a huge drop off of about 50%. Because in 2024, their bottom line per share is $6.15. And they're saying, hey, the best we can do right now is $3.05. Not good. So for me, I'm like, ooh, that kind of hurts to see. That's also because they do a majority of their manufacturing overseas, and tariffs and the cost to do business is really slapping them on the left nipple. It's like, ow, stop it, sir. And if we take a look at their balance sheet, I would argue this is a pretty messy situation that we are working with. In 2023, they had $9.8 million of cash and cash equivalents. Cash equivalents is basically anything that's super liquid. So money that's put into a CD, a certificate of deposit, money market fund, treasury bills, a high yield savings account, anything where you could just liquidate in 12 or 14 hours or whatever. So to go from that down to $3.9 billion and then down to $1.7 billion for the past 1 year, past 12 months, for me, that raises a red flag. You would have to dig into their 10K to figure out why is their margins being affected so heavily, because their net income is lower. But also number two, what is eating up all of the cash on the books? And then if we take a look at their loans, their total debt situation, $11.8 billion. So for me, I would argue this is a red flag. Their balance sheet is not looking too hot. I wonder if they're cash flow positive. Let me take a look at this. Their free cash flow. Oh, okay. So it looks like their free cash flow is improving from fiscal year of 2024 because it used to be 44 million. But now in the trailing 12 months, it's 542 million. So not bad, but it is a huge decrease from 2023 when they used to have $2.1 billion of free cash flow. So let's see. The free cash flow per share is 61 cents. So if you jump on over to their dividend profile, their annual dividend is 90 cents. So not looking too good. The dividend yield is 1.3%, and based on their earnings per share, then the payout ratio is 19%. But this number should be realistically around 30 to 33% because the EPS is now going to be about $3 and some change. So don't look at this number. It's not 20%. It's actually 30 to 33%. But finally, there is a green flag here. What I do like is that their dividend, this number right here, 90 cents, is growing at a rate of 14.5% year over year. So I think Carrier has a mix of good and bad, but I think it also highlights what happens if you do a good chunk of your business overseas, because you have to deal with geopolitics, tariffs, and anything else that's involved with procuring and sourcing and manufacturing overseas. It's just, it involves another variable that's hard to control, especially with the current administration. You don't know what's going to happen given the whole trade war nonsense that's happening right now. I just want the year that my daughter is born to be safe and steady and just peace and calm, but it seems like around the world there's so much chaos. But I digress because visually their dividends do look pretty good, and I'm trying to look at this for the past 10 years, but it's only showing us up to 2020. So even though we have all of their financial information, because by the way, to be publicly traded here in the US, dude, your financials and your books and your accounting, they need to be squeaky clean, because if it's not, you're going to be delisted. That's a huge shout out to the Chinese coffee company, Luckin Coffee. Dude, they were cooking the books. They were manipulating their numbers. They got delisted. You can't even invest into them as an American unless you want to put your money into wherever they're trading in. And to verify my hypothesis about short-lived history, yes, friends and family, they were debuted in the stock market March 2020. I feel like that's the week when the pandemic started, when everything was shut down. So it's a very weird timeline to be like, hey, we're initial public offering, we're being listed in the New York Stock Exchange, and it's like, oh, hey, the world is shutting down. But, dude, share price alone, even though their numbers are kind of shaky and inconsistent, I'm actually taken aback. How the heck are they 470% total return? Well, just for the share price. I'm getting ahead of myself. I want to bake in the dividends as well, because I feel like maybe that'll give us a more accurate picture. So once we bake in the dividends to their performance, year to date, we're talking about positive 1%. 1 year back, 1.9%. By the way, are you guys anything like me? I have a standing desk. Like if I back up, I don't use an office chair. And I stopped using an office chair, I think back in 2022. So I'm going on strong now for about 3.5 years of standing at my desk. And I will say this, my productivity has dramatically increased. Because one thing that I found is that when you're trying to do office work, i.e. like I'm a YouTuber that films, edits, does research all here in this little space right here. When it's too comfortable, like the chair and stuff, I found myself being more, what do you call it? Not sleepy, but a hint of more laziness affecting my ability to produce. Because I feel like when the office chair is just too cozy, you kind of just, you know what I'm saying? But now that I'm standing all the time, one thing that I notice is that my posture so much better. And number two, because I'm uncomfortable, I have like this sense of urgency to finish editing so that I can sit down. So even though I work from home and I put in about 50 to like 65 hours a week on YouTube, I probably only sit down roughly an hour and a half a day to eat meals, with my wife, or when we just watch something on Netflix. I don't really sit much. And I'm not saying all of this to be like, oh, today's video is sponsored by, dude, no one's gonna sponsor this YouTube channel. But anyways, if you haven't tried it yet, a standing desk is not the worst idea in the world. And it was pretty darn cheap to do. because I bought all of this wood, the raw materials, at a wood shop here in Japan, and I cut it myself with the help of my wife, put it together, and the total cost was like $32. Yeah, that's it. So not the worst idea, just saying. Past 3 years, 76%. Past 5 years, 169% for the past 5 years. I think that CAGR is going to be pretty darn amazing. And I just want to verify. So if we take a look at the past 5 years, wow. The compound annual growth rate is 22.7% year over year for the past 5 years on every year. In comparison, the benchmark, the S&P 500, 15.9%. But I would argue this number, even though it's really impressive, and I'm like infatuated, like, dude, your financials were shaky and volatile, but 22.7%, you might as well sign me up. If we look on down to Trane, which we already talked about, I think they were company number 1, past 5 years, their CAGR is 34%. So it's like, wow, that is just, didn't I tell you guys, the HVAC businesses and stocks, they deserve attention. When you're outperforming the market like this and you're posting numbers that rival everybody in the AI and the tech space, well, I guess they are in the AI space, but it just goes to show that there's beauty and potential in every single industry and sector. Well, maybe not every sector, but there's hidden gems everywhere. That's why I'm saying it doesn't take a rocket scientist to do investing. Invest in what you know. If you're a truck driver, you probably spend a bulk of your time on the road, and you see the differences year over year of like what cars are becoming more and more popular. If you're a software engineer, then you understand which software is actually good and which ones are just all hype, smoke and mirrors. And if you work at the mall in retail or whatever, whenever you take your lunch break, you can go to the food court and you can kind of see like a visual test of which businesses are thriving. You see the line that goes all the way out the back for Chipotle or Shake Shack. Whereas if you look at the line for Johnny Rockets, there's probably no one going to be in there. So there's potential in every sector and industry. I'm telling you right now, HVAC, who would have thought? But anyways, the next company is Ferguson, ticker symbol FERG, and they are a huge distributor of HVAC, plumbing, and industrial products. And what's interesting about them is that they do B2B with contractors. So they sell this stuff to contractors that go out and do their business. So unlike Home Depot or Lowe's, they're not operating retail stores. So when you think about Ferguson, they have lower overhead costs where they just keep all of their stuff in warehouses and then ship it directly to the plumbers that might need something. So when you think about it, Ferguson to me, on paper, it kind of sounds like Amazon for plumbers, HVAC technicians, and everybody else that's involved in that space, right? So please correct me if I'm wrong. They're not selling their HVAC equipment to the AI data center customers that, the project managers of that construction site of Google or Amazon, but instead they're selling their stuff to the contractors that will install that HVAC equipment for the employee's office room, the back room, the break room, whatever. But for cooling down servers and the cloud network infrastructure equipment, unfortunately, Ferguson is not running in that race. So they don't make specific products for that. However, despite that, dude, they're still crushing their numbers across the board. And according to their last earnings, I skimmed it and I was like, okay, everything looks pretty darn good. They increased their guidance for the year. So case in point, let's take a look at Ferguson. By the way, they're headquartered in the 757 in Virginia. I got my MBA from the College of William & Mary, so Ferguson was down the street from us. That's just a fun fact. Take a look at them year to date, just from the share price alone, 28.6%. Their price to sales ratio is pretty low, my goodness. And as a verification, their trading multiple for the future is a 21.8. Jeez. But let's see. Trailing 12 months, their revenue is $30.2 billion. Are you kidding me? Bro, that's bonkers. Since 2018, it grew by $10 billion. However, what I am keeping in mind is that the growth year over year is not that pretty, only 2.3% so far. And if we take a look at their net income, because remember, they raised their guidance, so hopefully that number improves. If we take a look at their earnings per share, it's $8.01. It looks like there's a common themality with the HVAC players in that they reached a high back during the pandemic and they just can't beat it anymore, and it's just declining year over year. So maybe that's like an industry thing, but also in 2022, we didn't have like the tariff trade wars happening, which I'm sure eating into their margins. And let's see, if we take a look at their balance sheet, ooh, $500 million of cash on hand, that's it? Dude, for how much revenue that they're generating and their net income, that's $5.8 billion of total debt. Ooh, that ratio is kind of high. My gosh. Are they free cash flow positive at least? $1.3 billion. It's pretty good. I feel like, yeah, that's a pretty respectable number, especially when you compare it to the net income. Not too bad. What's the free cash flow per share? $6.93. I think the earnings per share was like $8.01, I want to say. Yeah, $8.01. So keep those numbers in mind. Take a look at their dividend profile, $3. Oh yeah, dividend is absolutely sustainable, 1.4% dividend yield. Dividend could absolutely grow at a better rate than 5%, but I guess I can't complain. I guess the leadership team is choosing to be conservative and safe, because I've seen it time and time again where a company has like this one-off year where they outperform and their revenue grows by like 40%, right? And then they get all ambitious and say, oh, we're going to raise our dividend at a rate of 25%, only for them to just mess up the next year and their numbers fall off the cliff, and so they're only able to grow their dividend at a rate of like 1%. Rather than seeing a dividend growth that's fluctuating like that and it's all wonky, 5%, I guess that's respectable. To see if that checks out, if we take a look at it visually, it looks like 5% is kind of like what the leadership likes to grow it at. So maybe that's like a long-term strategic view of how they want to sustain their dividend. But it looks like, man, that dividend is really not growing at a rate that's respectable. In 2021, $2.52. I wonder if there was a stock split or something. Like, what caused their dividend to fall off the cliff like this? But anyways, if we take a look at their adjusted stock price total return, is it gonna populate? Doesn't look like he wants to populate. All right, now it's up and running. Past 1 year, 2%, nothing too impressive. Past 5 years, 178%. Wild. 10 years, 275. They have 20 years of history. They do a 16% total return in 20 years. Ooh. That's rough. In 2006, it looks like they used to trade for about $217, and now they're currently $223. So it appears during the great financial recession of 2008-2009, they just got absolutely hammered. They went from $200 a share down to like $16 a share. I think that explains a lot, because if we remove the Great Recession data, and when we look back to like 2010 and we do the 15-year history, then the total return is 1,100%. But holistically, to see this in their DNA and timeline, I'm kind of turned off. I'm like, ooh, that's bad. And the next company is Comfort Systems USA, ticker symbol FIX, and they do HVAC for commercial customers and data centers. However, they're pretty different from the others on this list, so you might want to pay attention. Comfort Systems goes and installs the HVAC into the buildings, which make up about 60% of their revenue. In maintenance and repairs, they make up about 30% of their revenue. And special projects, i.e. for the data centers, they make up the last 10 to 15% of their revenue breakdown. And their growth strategy is to buy out the competition and other MEP contractors, so the ones that are physically installing the HVAC into whatever location. So if your family HVAC business is crushing it in San Antonio, Texas, then eventually, with enough time, Comfort Systems is going to come and buy you out. Pretty interesting business model, but one could argue they are a blue-collar compounder. You'll see what I'm saying here in a little bit. And I listened to their most recent earnings, and the guidance and everything, the numbers do nothing short of spectacular. Their backlog right now is $8.1 billion. And if we take a look at their numbers, it's a pretty compelling story. So I think the first thing we should do is look at their, by the way, you want to take a look at their stock price? Look at this. If we rewind 5 years around this time in 2020, August, dude, they were roughly, what is this, $52 a share. They're now $700 a share. Dude, that's diabolical. By the way, I'm losing steam. I've been filming for like an hour and 29? What, hour and 35 minutes. So I'm kind of losing my energy, but we only have this one and one more to go. And then at the end, I'll give you guys my price targets. If we take a look at their top line situation, dude, this is really beautiful. 2015 is 1.5 billion. My goodness, now 7.6 billion. Dude, that is absolutely... Their earnings per share right now is $19.44. What you have to understand is in 2015, it was $1.30. Dude, this growth is absolutely dirty. I'm almost offended. How the heck do you grow your earnings per share by 70%, 30%, 60%, 60%? That means I have inclination to believe that they're not diluting the shareholders. Meaning, because they're posting better numbers and the amount of shares outstanding is stabilized, that's why their EPS is so beautiful. I just want to fact check myself. And sure enough, when you look at the data in 2013, there was 38 million shares outstanding and they've been slowly buying back the shares. Now there's 36 million. That's what happens when you don't dilute the shareholders. This is a pretty good picture to see. Here is more visually accurate of what it's going from, like from here down to here. 38 million to 36 million, but it's still good. And if we take a look at their books, their cash and cash equivalent situation looks pretty darn good. I'm looking at the percentage change year over year. Dude, I like what I see so far. Take a look at their debt situation, $311 million of debt. That means after you pay off all of the loans on the books, you have $27 million of cash left over. So their cash situation, their balance sheet looks really phenomenal, really strong. Even if they face setbacks or headwinds, they have enough money on hand to weather the storm. And that's why it's important. Take a look at their free cash flow situation. I hope they're a dividend payer. Free cash flow per share, $15.76. Their free cash flow did decrease year over year. Let's see, it decreased by 9.7%, but I would argue in the grand scheme of things, it's still pretty good. Pretty much the exact same numbers as 2023. About $500 million, about $500 million. Look at their dividend profile. 0.26% dividend yield, come on. Dude. This number right here, $1.80, growing at a rate of 54. Man, that's just, this has to be fake news. Let's take a look at it. Dude, this is just, have you ever heard of this company before? Comfort Systems USA, ticker symbol FIX. Woo, girl. Okay, so if we take a look at their performance, I can only imagine that their CAGR, their total return, is just going to be absolutely bonkers. I should have started the video out with this one. So if we do year to date, we're talking about 60. Dude, this is comical. To see numbers like this, pretty wild. If we zoom back 560% for the past 3 years. To invest into a company full of technicians that go out and install HVAC equipment. Dude, that is just, that almost makes me want to stop everything that I'm doing and just go to trade school and become an HVAC technician, learn the trade, learn the business, and work for Comfort Systems and work my way up the ladder in their corporate. My goodness gracious, 560%. Past 5 years. Dude, I'm almost like, do you know what I mean? Like fake news, 1,200%. Oh my gosh, it just gets better and better. Dude, past 20 years, 8,700% total return. Can you just fathom that for a second? If you have like $100,000 invested into them 20 years ago, you see, one of my biggest life regrets is back in college, I had no interest at all about anything to do with personal finance, anything to do with the stock market investments. I did not care. If I could go back in time, I really wish I would have invested even like $10 or even $20 into Comfort Systems, into Apple, into Microsoft, anything and all of the products that I was using at the time. I don't know why I didn't think of investing into them. It just wasn't a part of my vernacular. I just didn't care. And I'm being completely honest when I say this. If you are invested into comfort systems, dude, I would shake your hand right now. I am proud of you. I don't know how you saw it before everyone else. Now I almost feel like the ship has sailed. Right? It's like, everybody knows about it at this point. All right, friends and family, now we have made it to the last HVAC company. And dude, I am getting super tired after filming for so freaking long. But it's going to be Johnson Controls. Ticker symbol JCI. They're in the business of selling building controls and smart systems like thermostats and sensors. But they also do installation services of HVAC equipment, fire alarm sprinklers, and security systems. They kind of do everything. They kind of remind me of like Honeywell and 3M, kinda, but not exactly. And when it comes to Johnson Controls, unlike the other ones on this list, they're not all in HVAC. Right? So consequently, they've been a slow and steady performer. No hyper-aggressive growth numbers like the others on this list because they're related to the data center growth movement, but it's not the pillar of their business model. However, they are still important because as buildings and as warehouses are being built out for data centers and to make our buildings more green, Johnson Controls and their products are still going to be a vital ingredient, just not the biggest chunk of change, not the biggest revenue driver. But anyways, if we jump on over to take a look at their numbers and their financials, $105 a share, current PE is a 34, so it looks like almost every single one of them trade for a premium, right? None of them are on discount. Well, actually, what was Carriers again? I think they were the only one that was kind of cheap. No, even them, they're 39. Was AAON cheap? No, 43. So they're all trading for a premium that rival like AMD, Nvidia, pretty high trading multiples. Take a look at their financials. So their revenue in 2017 was $22.8 billion. Trailing 12 months, it's $23.4 billion. Hardly any growth, very slow mover. However, it does look like in the past 12 months that their revenue did grow by 14%. So they're doing something right. And I think it's because of their involvement with the data centers that are sprouting up. Take a look at, I guess that's their catalyst and why the trajectory of their company is now changing. Take a look at their EPS. Yes, I mean, they're doing pretty good, right? 41% increase year over year for their bottom line per share. Can't argue with that. Take a look at their books, $731 million. I bet they have a lot of debt. I just have this weird feeling in my right nipple. $10.2 billion. So I feel like their debt situation is kind of high, especially in relation to their cash on the books. Free cash flow, is there anything that is a call out? $4.33. Do they pay a dividend? They do. Oh, and it's absolutely sustainable. Yeah. 1.4% dividend yield, dividend growth, non-existent. Oh, yeah. The dividend is pretty much the same as it was back in 2023. So, if we jump on over and take a look at the performance in the stock market, hang in there. We're almost done, guys. We're almost there. We're going to be going over the price targets here in a second. And by the way, earlier with Comfort Systems USA, we took a look at their share price total return, but not the adjusted stock price that bakes in the dividend. So if we do 20 years for Comfort Systems, then it's 10,900% in 20 years. So that number that we talked about earlier, that $400 million, it would have been even higher. So now we're going to compare that to Johnson Controls, ticker symbol JCI. Past 1 year, let's see, Johnson Controls was 49%. That's still pretty respectable. 20 years, I'm actually kind of surprised right now. Based on their revenue and their numbers looking a little wonky for Johnson Controls, past 20 years, 4,000%. 4,000, dude, riddle me that. That's pretty good. And you made it, friends and family. Now we're looking at what I believe the inherent worth of each one of these HVAC companies to be. And it seems like for most of them, based on my calculation and analysis, I think some of them are overvalued and most of them have hit their price targets. But there's only two that stand out to me that are near their good value price, meaning baking in a margin of safety and a little bit of discount, and their stock price being near their 1 year low. The two include AAON and Carrier Global. I think for AAON, they should be about $94.50. I think right now they're like $80, $82. I would personally buy into them if they dip on down back to $75. Barring any crazy changes to their guidance and outlook, like, hey, we've pooped our pants, our business model is changing, now we're going to sell packaged muffins. If they do something like that, then obviously I'm not going to buy into them. But if their business model is intact, their revenue growth guidance is still 12.5% year over year, I think they should be $94. And right now they're trading for a discount. So AAON, they're absolutely on my radar. And then the second one that I think is kind of on a discount right now is Carrier Global. My buy price for them is $55. And I think their intrinsic valuation, their inherent worth, is about $74. And based on what I see on my second screen right now, they went on a massive dip based on their last earnings report. They're $68. So for me, I would buy them at $55, but I think I wouldn't mind buying into them at around $61, $60. So if they continue to dip, I'd probably buy into them. But to be honest with you, all 7 of these, I don't think I could go wrong with any of them. I think my least favorite is probably Johnson Controls, even though they do have good performance in the stock market. Based on the growth of their business, inherent based on their top line and the revenue, not a fan of what I saw, plus their debt situation, and of course their dividend profile not growing. If I had it my way, and every single one of them were on a dip, and they were all in the yellow category right here, this column, under value territory, I think hands down, I would go with Comfort Systems USA. There's just no doubt in my mind that's the one I would go with. And then I think a close second would be AAON. So based on the factors and the numbers that are happening, depending on when you watch this, some of them might be into the yellow bracket. But as of right now, these are the only 2 that are near this column. I think after doing my research and getting to know these companies, I think I'm going to put in buy orders for AAON because I think I can pull the trigger and buy into them at around 75. I think they will fluctuate and hit that number. So that's personally what I'm going to do. So my question to you is, what are you going to do? Are you invested into them? Are you a part of the HVAC industry? What are your thoughts and opinions? Because I would love constructive feedback or even just encouragement like, dude, I love the video or I hated your video. And I want to say it one more time, a huge shout out to those of you that are supporting me on Patreon. I genuinely appreciate you guys. I don't take you for granted. So thank you so much for believing in me and in this channel and helping me to do what I do. With all of that said, I love you guys. Stay safe. Good luck in the stock market, and I'll talk to you really soon. I got to go out and continue running because I'm preparing for my first marathon, so that's what I'm going to be doing. And then I'll edit this video. I hope you guys have a good weekend. Peace.